Welcome into America's Retirement Headquarters, home of the Retirement Guys Formula and America's Medicare Associates. Securities offered through Peak Brokerage Services, LLC. Advisory services offered through the Retirement Guys Formula, registered investment advisor. America's Retirement Headquarters, America's Medicare Associates, and the Retirement Guys Formula are separate and independent entities from Peak Brokerage Services, LLC. Welcome into, and thanks so much for joining us here on America's Retirement Headquarters. It's the home of the Retirement Guys Formula and America's Medicare Associates with Nolan Baker. Myself, my name is Chris Swan. 419-794-3030 is the phone number. That's 419-794-3030. You can find them online at arhq.com. Today on the show, what is the formula for picking stocks? And we'll talk about how to fight the fear of running out of money and when should a married couple start Social Security. All this and more, but first let me say hello to and welcome back to Nolan Baker. Nolan, glad to be with you. How are you, sir?
It's good. Yeah, good to be in the hot seat. I know I took a little bit of a travel there with my son having spring break. We took him to Washington, D.C., so he's never been out to Washington, D.C., and as many of you listeners know, my youngest son and both my kids played hockey, but my youngest is an avid fan of hockey, so we stopped and watched a game in Pittsburgh. And we watched the Capitals play in D.C., and then we rounded out our trip with watching the Philadelphia Flyers play in Philly, and even got a Philly cheesesteak. So it wasn't a bad trip, but it's always good to be back in the hot seat.
No, we appreciate you taking time of your schedule, to spend with the listeners, give them a little insight and wisdom as they get closer and closer to retirement. Let's kick it off with this because, everyone on Wall Street, they're looking for the next high-flying stock because they make great headlines, but you need to read the story below the headline. For example, Carvana, the car retailer, they'll buy or sell your car online, even deliver it to your house. I have friends who have utilized Carvana. They've had good experiences. It sounds like a great service. In 2023, shares of Carvana rose by more than 1,000%. If you just stop right there, you might want to buy this stock. But if you go a little further, look under that headline, you look at where Carvana was in 2021, they still end the year down 86%. Now, most people decide to buy a stock or decide on a 401k fund by looking at past performance. There's a disclaimer that we use in every show. Past performance does not dictate future results. What is wrong with that practice, looking in the past, and how can you help people do better than that?
Well, when you're looking at what is the formula for picking stocks, I do agree with you that, past performance does not really dictate what the future outcome is going to be. And, even in the examples of some of these high-flying hot stocks, I mean, with social media today, what you have is anybody's willing to give you their opinion on what a good investment is or, what the hot investment is. I see it on some of, my social media that's out there. The first thing is I caution you to make sure that you check into the background of the person who's giving you financial advice. Also, you'd want to look at, maybe what is their motivation and to giving you advice. So some people say, get completely out of the market. You want to put your money in precious metals. Oh, by the way, we can help you buy precious metals. And, some people say, don't put money in annuities. And, oh, by the way, put it all in the stock market. And by the way, we do the stock market. So you kind of have to know, what is the outcome. But, what I'm going to do is I'm going to give our listeners, what I believe is my 30 years of knowledge of trying to figure out, what the formula is for picking stocks. In fact, this is something that I go through every single time that we have somebody come in the office. And what we do is we offer what is called our Retirement Team Action Plan. And so within our Retirement Team Action Plan, it's 4 sections. The team stands for taxes, estate planning, asset protection, money management. And when we go through the Team Action Plan, in this particular topic, we're talking about the M, the Money Management Optimizer and Stress Test. And one of the questions that I'll ask folks is they'll be sitting, down with me, and I'll ask them, explain to me what the methodology and philosophy it is in your current investment approach. In this example, the result was somebody had talked about picking investments in their 401k based upon past performance. And in fact, I do hear that happen a lot of times. People will pick investments based upon past performance. I don't believe that's a disciplined investment strategy because, again, what happened in the past may not, happen in the future. I'd also say that, 60, 70% of the time, people will look at me kind of like a deer in headlights, meaning that they don't truly understand what their investment methodology and philosophy is. And what's concerning about that is The next time there's a challenge overall within the markets, and the markets get a little bit volatile, to me, somebody who doesn't understand the formula for picking stocks is probably the most likely one to make more of an emotional short-term decision about, when to buy and when to sell and when to get out. So again, a part of this retirement team action plan, this is something that we give complimentary for our listeners or people that, have over $250,000 of investment assets, is we begin to kind of help them develop what is called their investment policy statement. And when we're going through this, the characteristics to me that really kind of jump out as some of the key principles, at least when our office is looking for advice to give somebody about what to own, is number one, we typically look for companies that have a high cash requirement. So they have to have a minimum amount of money in their bank account. The second thing is we look for companies that have to have a low debt. It's been my experience in 30 years looking at recessions and when times get tough, companies that don't have a lot of cash or have a lot of debt, or even families for a matter that live that way, those are the first companies that go out of business. So if we can identify high cash, number two, low debt companies, hopefully we've identified companies that if we have this recession coming up, that are going to be strong enough that they can not only, weather through that, they can actually be able to be in a position to take advantage of the opportunities, maybe of their competitors that aren't in such a good position. Number three, we want to look at the profit margin. So we want to look at, profitable companies, and we want to establish a benchmark for this is what we want to look at when we look at the profit margin for companies and like return on equity. Number four is we want to look at companies that have a competitive advantage. There's a lot of different cell phone companies that are out there today. I think some companies have a competitive advantage over the other one. If we look at the internet and I go on the internet, there's a couple of different search engines that I can use to find information on the internet, but there's one dominant leader that has a competitive advantage. If you think about shopping online or different companies like that, there's companies that right now have a competitive advantage. I love companies that have a competitive advantage. Mm-hmm. And then the last characteristics are companies that are needed on a daily basis. In my house, since we were gone for traveling with my son and the DC trip, we let our groceries kind of get a little bit low. And I know when we got home, one of the things my wife said is, "Hey, I'm going to go to the grocery store. And I'm going to hit a couple of different stores this week. What do you want?" And I think daily essential companies like the grocery stores, the cereal companies, the cleaning supplies, the things that we're going to need every day tend to be even a little bit more defensive, in an environment where things get a little bit more challenging. So even if we're in a recession, my kids are still going to get up in the morning. They're going to have their breakfast cereal. I'm going to clean, the counter with some cleaning supplies. My wife's still going to go to the groceries. Maybe she'll be a little bit more conscious about what she searches for. And then the final thing from that is once you understand what you own and why you own what you own, the next thing is you want to decide whether you want to have circuit breakers on a portfolio. So what circuit breakers are a clearly defined entry and exit point. So if you're thinking, hey, right now, should I be more in fixed income or should I get more into the stock market because of what's happening with the economy? Again, trying to define what that entry and exit point is, what circuit breakers are all about. So if you want to learn more about that approach and the formula for picking stocks, I love this discussion. This can be part of what we do. Again, is one of the four components, and what we offer is, again, complementary to our listeners that have more than $250,000 in our retirement team action plan. So we're going to look at the T, the tax savers checklist and a tax roadmap for 2024. We're going to look at number E, which is your estate planning blueprint. We're going to go over A, which is your asset protection game plan, talking to you about, navigating the healthcare environment, actually making things affordable, and then how to put a shield around your assets to protect them from long-term care. And then the fourth section, like we talked about just now in this section, is the money management optimizer and stress test. So if you want that, just call the office, just ask for the retirement team action plan, and we'll get that put together for you and help you become a better investor and developing a formula for picking your investments.
That phone number is 419-794-3030. Once again, that's 419-794-3030. 3030. If you're a longtime listener or viewer of the show, you'll know that this investment methodology is not something that they've just developed kind of overnight. This is something that they've been talking about for years and years. It is the way that they've looked at the investment process for a good while now, and it is something that seems to be pretty tried and true. So if you want to figure out your current investment methodology, maybe see how theirs works with you, take advantage of this retirement team action plan offer. If you've got $250,000 or more of investable assets, pick up the phone, give a call, 419-794-3030, or you can reach out to the website, and that's at arhq.com. Now, this is the season for weddings, and if you're planning one, well, how much time do you have? A new study by Minted found that the average person spends 12 hours a week planning their wedding, which adds up to more than 500 hours, all for, one day, one celebration. On the other hand, some wedding planners, they claim their services can give back about half of that time. Now, let's not talk weddings here because that's not what you guys do. Let's talk about what you offer. How do you help clients save time and money by planning, the 20 to 40 years they could be spending in their retirement?
I was, definitely pretty shocked when I looked at that. More than 500 hours all in one day is what a typical wedding planner would be. And I go back, I guess, my wife and I have been together for 30 years now. And I think about, when we got married, there was a lot of planning and what had gone in. And so I definitely think there's probably some value to working with a wedding planner inside of that. I did surprise my wife several years after that when we were in Las Vegas and did a surprise renewal out in Las Vegas. I can say that was much easier because I just paid Paris and their wedding planner to do everything. All I had to do was just show up, get on my knee on the Eiffel Tower, and the rest was taken care of. So I can definitely see the value of paying for somebody in a couple of different scenarios. In fact, I think about my kids and life lessons that, we've worked with them. My youngest son has a Jeep, and with his Jeep, to me, it's kind of like a big Lego, and he has loved Legos. Both my boys have ever since they were born. And so, for him tearing apart his Jeep and putting new pieces and parts on it and wrapping it and doing this and spending time out there is something that he has a lot of enjoyment with. My youngest son came up to me about a week ago and he said, "Hey, Dad, when I stop at the gas station and, I pull the trigger at the pump, it always just clicks off right away, and I can't figure that out." And, naturally I went on and Googled it and looked at some YouTube and looked at some articles and found out it could be a couple of different things. But I said to myself, you know what? This is a gas tank, and this is his gas. This is an area that, yes, maybe I could figure out some time to do, but I'm better off leaving this one to the professionals than dealing with his gasoline. So in this case, I saw the value of not catching myself on fire and doing something bad and, just paid the professionals. And a lot of this, I guess, it kind of transpires into people spending time and money working with a financial professional. Because, again, we're not talking about one day. We're not talking about one event on the car. We're talking about this is money that has to last the rest of your lifetime. And, having a co-pilot or somebody sitting next to you that can say, hey, watch out, or, pay attention, or here's an opportunity, or here's a safer route to go. That can really be a lot of the advisor value and how they can help save you time. I think about just one simple step in like an hour of investment of somebody's time, how much savings it can put into them. And that's what we refer to as our retirement team action plan. And within the retirement team action plan, what we're able to do is take our knowledge and my 30 years of experience and then our team's knowledge, and we're able to put together a one-page summary that talks about, opportunities and threats that are facing retirees when you look at the team action plan. So team stands for taxes, estate planning, asset protection, and money management. So you don't have to give 500 hours like a wedding, but for 1 hour, the retirement team action plan can really kind of help show you what the value is as working with a financial retirement team like America's Retirement Headquarters and save you time. But part of that comes down to expertise and knowledge, right? I have learned a lot of this through just going through life's lessons. Like I've been through COVID. I've been through 2008. I've been through, the crash of 2001 and 2002. These things I think help create somebody that can help you navigate that environment. Investment strategies, learning that disciplined investment approach, having a methodology versus just watching what's on TV. Some people talk about how they love annuities, and some people talk about how they hate annuities. That in itself is a confusing topic, which is why we have our educational series that is going on throughout the year. In fact, coming up in the month of May, we do have an event that we're talking about the good, the bad, and the fine print, and the truth about retirement income and annuities. So if you have an annuity, if you've thought good things or bad things about annuities, and you really want to better understand the complexity of those, make sure you go to arhq.com, click on the events tab, and you can register for that event that we have coming up, Mancy's Italian. It's on May 14th and also on May 21st. So Tuesday night dinner event. Should be a fun one. But again, those custom tailored situations, allowing you to understand what the complexity is and having somebody kind of break it down into your own process. Third is with the investment management. You know, our team is getting together on a weekly basis, meeting every week. We have an investment committee meeting that we do every month where we're diving deeper into the investment portfolios. We're doing things like providing email alerts, customization, and making some of those changes automatically in a portfolio that can be time consuming. It's tough sometimes to monitor those, to rebalance, make adjustments. So if you're listening out there and you do it yourself, but maybe you want somebody to help guide you, we can show you some of the technology that we have. Or if you want an investment approach that's not just, hey, set it and forget it, it'll be fine. You feel like you're not getting anybody that's providing that ongoing management. Again, I would say take a look at what our approach is. The access to the different tools and resources. Last week, we had something called our lab technology training. With our lab technology training, what we did is we invited our clients to come in. That way, they had an opportunity to see the financial planning software that we had, how we can do the autopilot advice on their 401k, how to be able to access their accounts in one consolidated place online. And using that and the different tools and resources, things like our semi-annual economic update, are giving people the ammunition to be able to be successful and help streamline that investment process. And then the fifth thing is it allows us to do monitoring and adjustments along the way. Not only does that come out for us in our investment committee meeting, we're looking at that and we're using technology to put that together. So overall, I'm biased. I'm a retirement planner. And so having a professional can absolutely save you some time, give you some specialized guidance, personalized financial planning, investment management, access to tools, ongoing adjustments in a financial plan. But I know that, that can be sometimes a bit overwhelming, everything I just described for you. So the easiest thing for you to figure out if it's going to add value to you in your situation is take a baby step. And what that baby step is to get the retirement team action plan. So that's an easy one-page summary that's going to show you, what could be the value of developing a relationship with an advisor that, again, could save you time over the course of that. Before you do that, though, we're going to go over this retirement team action plan that summarizes the tax saver checklist and roadmap, the estate planning blueprint, your asset protection game plan, and the money management optimization and stress test is all included. Again, if you have more than $250,000 of investment assets, if you haven't got that routine action plan, give us a call. We'd be happy to get that to you.
And once again, that phone number is 419-794-3030. Nolan, just in the way, that you don't feel comfortable necessarily working on your son's gas tank, I refuse to do any electrical work in my own house for that same reason, because if I make a mistake, that could be pretty catastrophic. One could argue when it comes to retirement planning, going at your own, not knowing all the ins and outs, could have some serious ramifications. So a lot of upside to certainly working with a professional or professionals like the team at America's Retirement Headquarters. Let them put their combined 75 plus years of experience to work for you, whether that is, coming into one of their upcoming events. You can check that out at arhq.com. Click on the events tab, whether that is starting with the retirement team action plan. It could be that initial hour and a half of your time could be some of the most valuable time you spend on the way towards retirement. So once again, that number, 419-794-3030. Now, year after year, the stories and surveys reach the same results. The number one fear of people in retirement is running out of money. There's an article in the Washington Post that interviewed several people that have done a really good job saving for retirement, a lot of them debt-free, a lot of them with pretty nice pensions. But you know what? That fear, it's still there. They just can't shake off that insecurity of walking away from that regular paycheck every 2 weeks. As a retirement planner, how do you guys help explain that, and how do you help address that fear?
Well, fighting the fear of running out of money is the real deal. I mean, I think that is the number one concern for people that are close to or in retirement time. And when we look at it, I can think of a couple of specific examples. These are some people that recently came in, and what they did is they took advantage of our retirement team action plan. This is that one-page summary where we go over taxes, estate planning, asset protection, money management, and by doing that, we're diving deep and we're looking for potential threats or dangers that are in their current plan, and we're looking for maybe opportunities on how to get things to be a little bit better and improved. And I can think of a couple of examples of people that came in. First, let's use the example of Martin and Sherry. They're in their late 60s, early 70s. They completed that retirement team action plan with our office. And what they had is they had an annuity that they had purchased several years ago. Now, people can buy annuities for different reasons. There's good and bad things about annuities. In fact, we've got that event May 14th and May 21st coming up for the folks that are right here in Northwest Ohio at Mancy's Italian Grill, where I'll be diving deeper into this topic. So if you want to learn more about lifetime income, register for that event. But when we went through the analysis for them, what we had realized is they could upgrade their old annuity because of where interest rates were today. Plus, he's a little bit older from when he took it out. And they would get a 30% increase in his income. And in addition to that, because of the cost structure of some of the annuities that are out there, we were able to get rid of the expensive annuity and find an annuity that reduced his expense ratio by over 50%. That's one of the things that I love about my job. Martin and Sherry walked out of our office, not only with that, with everything else on the team action plan, but that one item alone put $3,000 more of income into their plan, helping them, gain some confidence of fighting that fear of outliving the money. And, inflation's been the real deal. So having that extra money helped out quite a bit. One other example, because I know we're coming up pretty soon on the break here, was Robin. And Robin had come into the office. And again, what we were able to do by going through that retirement team action plan is identify that she had an annuity. Now, this is one of the annuities that some people talk bad about, which is typically referred to as a variable annuity. The reason being is they tend to be more expensive. They tend to still have risk associated with them. So again, they're right and wrong. It's not one scenario for everybody, but they tend to be the more expensive ones. We were able to look at that, and we were able to take and reposition a portion of that money, get rid of a bunch of those higher expenses, get rid of the risk that was associated with it, and generate the same level of income with only 60% of the account. And so in Robin's situation, what we were able to do is we were able to free up 40% of that money for her to do other things with. So that could be the house project that she's been thinking about. Maybe that could be that vacation that she's been pushed off for a little bit. That's maybe just more peace of mind that she can have in another investment account, so that by doing that and refinancing the account made a big, big difference. So if you're fighting that fear of running out of money, and even more specific, if you have wondered about annuities, or if you own an annuity, the truth about retirement annuities and income, the good, the bad, and the fine print that's coming up here in a couple of weeks, May 14th at 6 p.m. and May 21st at 6 p.m. at Mancy's Italian Grill, is one of those events that you really want to come and get educated about, find out about where the changes have been. I've seen the biggest changes in the last year with annuities than I've seen since my children have been born, and I have a 20-year-old, right? It's been 20 years that we've seen so much big changes in the last year because of interest rates have happened, and that it's worth becoming more educated about how to do that. Now, in addition, at this event, I'm going to share the other ways to generate retirement income, gain that confidence and peace of mind, developing and following the process of what we call the independent income system, which is that comprehensive approach. Or, if you want to skip coming to that event and you want to jump to the front of the line, the best way to do that is to get a copy of our retirement team action plan, because that's just one of the 4 items that we're going to review for you on that team action plan. Again, we're going to look at your tax savers checklist, estate planning blueprint, and your asset protection game plan, along with that money management optimizer. And that X-ray report might be a way to get you more income in your pocket, help give you more confidence, and help you avoid that fear of outliving your income.
Addressing it head on, it all starts with that phone call, 419-794-3030, whether it is attending the upcoming events that they've got going on coming up next month, or, like Nolan said, they're skipping the line and sitting down with them, that retirement team action plan. If you've got $250,000 or more of investable assets, they'd love to sit down with you, start developing that plan. The phone number again, 419-794-3030. Don't take inaction when it comes to a concern you might have about retirement. Go and take action, reach out and see where you stand and how to, maybe you find out you're in a better position. 419-794-3030 or arhq.com. Now, choosing the right age to claim Social Security is hard enough, but the Motley Fool says it's even harder if you're married. Why is that, Nolan? Wouldn't you both either claim your benefits early or claim them later? What difference does it actually make whether you're married or single?
It makes a ton of difference. I mean, the decision that you make with Social Security, after a year becomes an irrevocable decision. It's one of those things that you got to get it right. If you look at the stats that are out there, it's pretty scary on some of the decisions that people are making. For those of you that are not collecting Social Security, what I would tell you is that this is a topic that we have the software and we can run a customized analysis for you and show you what your numbers are. We also have a wealth of information that's available on our YouTube channel. So if you go over to YouTube and type in America's Retirement Headquarters, hit that subscribe button, and you can look for, under the video, some of the Social Security topics that we talk about. We dive really deep into this. And another cool thing about our stats on YouTube is we just got to over 1,000 views on YouTube. So I know we just recently launched our YouTube channel not that long ago, and it's cool to have over 1,000 viewers. Another great milestone on there. And we put a lot of wealth of information. But going back over to looking at the decision a married couple should make when Social Security, what the numbers say right now is that the overwhelming majority of people are making a decision to claim Social Security early. And so the definition of early is taking benefits before what is considered your full retirement age. And so most people that are close to are moving into retirement. Their traditional retirement age is that, 66, 67 number. The younger you are, the longer it goes. And they are taking benefits then between the ages of 62 and let's just say 66 for the purpose of this segment. By doing that, what you're doing is you're taking a lifetime reduction in penalty and benefits. And so you're negatively impacting yourself and possibly your survivor benefits in the future by selecting benefits that are early. And so then I'll ask audiences all the time, I'll say, well, why are you doing that? And well, one of the people think that, one, it's natural to just go ahead and select Social Security right away at retirement. You need income, so might as well take the income from Social Security. Other times people are worried about the fact of, outliving their income and the fact that, Social Security is going to go broke, so they better get what they can while they can now. And then the other scenario is you have people that say, well, nobody in my family lived past 75. And so I've run the break-even analysis and, since nobody in my family's lived that long, I better just take it before, since I don't live that long. I want you to look at things in Social Security as a married couple in a different way. First of all, I want you to realize that Social Security can be one of your biggest financial assets of your lifetime. You have paid into the government your entire lifetime that you've been contributing to the Social Security. It is not your constitutional duty to let them keep your money. I think you should do whatever you possibly can to get them to pay you back the most amount of money for the rest of your lifetime. And how you do that is you optimize your benefits. So let's break down a couple of these. If we look at a scenario of somebody drawing benefits early versus somebody waiting till later on in life, the cumulative difference when I did it, and I just did kind of an analysis for a retirement couple. In this case, the earlies filed at age 62. They got $21.50 a month in Social Security benefits. And then the laters claimed Social Security later on in life at like 69 or age 70. The cumulative difference of that on a monthly basis can be, in our example, like $3,600 a month, all the way up to, if you add up the cumulative difference between that couple's lifetime, it's $271,000 in the example that we ran recently when we were looking at a couple. So it's big dollars. It's a big difference over time. So taking it early could be a costly mistake in the long term. The second scenario is you have the higher income earner think, well, I don't have a good health, I better just get it now. But what you may be thinking about is by taking your benefits early and not waiting till later or even delaying benefits, you're possibly negatively impacting your survivor benefit. So you've actually, in a married couple, quite possibly locked your family into a terrible decision just simply because you thought your health wasn't going to be there. If I was a betting man, I would bet on the two of you lasting a long time. So when we run this analysis, we can show you different scenarios about what if you pass away early, what if you live long, and help you make a decision based upon, both of you and your lifetime income. Third scenario is people say, well, it's just going to go broke. I better get it while I can. It's absolutely true that, somebody in Washington is going to have to make some tough decisions about how to reform Social Security. And I know that I've got some YouTube comments that people have been fired up about this topic as well. And I'd be fired up too, right? You've paid in your entire lifetime and they're telling us in less than 10 years that they don't have enough money. So somebody has to fix that, and it could be dangerous. But what I would say is my belief, although Washington doesn't care what my belief is for those people either on Social Security or close to Social Security, there could be some changes that come along the way, but count on Social Security being there as kind of a cornerstone for your overall retirement as well. So don't let those three reasons make you make a decision to select Social Security early. It could be a costly mistake. And that, again, when we think about lifetime income, this is one of the things that we talk about when we do this retirement team action plan. So in a retirement team action plan, we're looking at how to fit all of this together because sometimes it's better off to delay Social Security. Well, I'm not saying that you have to keep working longer. So if you don't delay retirement, that means maybe you pull out of your 401k a little bit early. And if you pull out of your 401k and you retire before 65, that could impact what your health insurance cost is. So all of these areas typically roll together. And so one of the most powerful things that you, our listener, can do is get a copy of our retirement team action plan. So the team is not only all of us here at America's Retirement Headquarters, we're one location to have all of your retirement needs taken care of. It also stands for T for taxes, E for estate planning, A for asset protection, and M for money management. So the retirement team action plan is something that if Social Security and lifetime income is one of those topics that you're like, Nolan, I've got to check that out, but I also need to know what are the other things that I should be doing to generate a good retirement that I understand and I'm confident about. Call our office and ask for that retirement team action plan, and we'll put one together for you.
It all starts with that phone call, 419-794-3030. Social Security, no politician is going to outright say they're going to get rid of Social Security. That would be, the end of their career. But the truth of it is there may be a change in the benefits down the line. That is not to scare you into claiming it as soon as possible. That could be counterintuitive. You could end up giving more back in taxes and not what you want to do. Have a plan put in place, figure out the right time. And also, one of the things that the team at America's Retirement Headquarters does is if there is a change down the line, if there is a reduction in benefits, how do you find ways to replace that income? How do you find ways to supplement that? It all starts with reaching out, picking the phone, giving a call, and start developing that retirement team action plan. 419-794-3030 is the number, and the website is arhq.com. Dollar Tree stores, they've noticed a change in the customers coming through their doors. The chain says people with higher incomes, 6 figures or more, they're actually shopping there now, and that is the primary reason the Dollar Tree is now stocking higher price products up to $7 in price tags. In the financial world, some products come with fees and some do not. Nolan, how do you guys educate investors about what fees to look for when it comes to investing?
There definitely is a lot, I think, to look for when you're looking at what are the fees when it comes to investing. And the reason being is a fee is a controllable item, meaning that by investment selection process, you can pick investments that don't have fees, and some investments, on the other hand, do have fees. And the cheapest isn't always the best, but cost absolutely is one of the key characteristics to being successful in investing. There's different products that are out there. Traditionally, when you think about most like fixed annuities, a lot of index annuities, you could have bank CDs, you could have checking savings accounts. These are traditionally the type of products that you're thinking about on investments that have no fees. And all of those can be part of an overall plan. There's reasons to have those as part of your vehicles. In fact, we discuss a lot of where to utilize these tools in what is called the independent income system. So if you haven't learned about, our philosophy or methodology, and you want to learn more about not only fees and expenses, but how to put it all together, just go on the internet and Google independent income system, and then you'll learn about our methodology and philosophy of when to put it together. On the flip end of the scale, when you go on the other side, there are different annuities that have fees and expenses. There's different private investments that are out there. Some of these commercials where you can purchase like precious metals, or when you invest money into the stock and bond market, variable annuities. These products have costs associated with them, and they're costs that you really want to be aware of. And it's an area that we can help go through an X-ray on the Retirement Team Action Plan. But when we go through and we take a look at it, and we're thinking about, let's call it the stock and bond market, the first thing that's pretty common these days is what's called management fees. And these are, typically the fees that are charged by the investment manager for managing the portfolio. They're typically expressed in a percentage of assets under management, and they can vary depending upon the different type of investment management that you have and the different firm or strategy that you have. It's common that these fees range in the 1% to 2% on an annual basis. Some fees, again, vary. Number two is you can have expense ratios. So expense ratios can be, commonly referred to as some of the operating expenses. Expense ratios are common in like mutual funds or exchange traded funds. It's a percentage of the net asset value. They cover those management fees, administrative costs, other operational expenses. Lower expense ratios indicate lower cost for investors. This is an area, where you can, again, control that. And a lot of these areas, the cost has, come down in the industry. And when you look at expense ratios, to me, when you look at expense ratios, these are an area that for the average investor, it gets a little bit harder to notice. Like a management fee we were talking about earlier, you see the number, it's usually printed out on your custodial statement. You see what the dollar amount is. Expense ratios tend to be a little bit more challenging, especially when you deal with variable annuities. Variable annuities can have some good features and benefits for the right person, but they tend to be more expensive in having these expense ratios, because not only you get some of these operating expenses, you have to look at like mortality and admin costs. You have to look at any rider cost that's associated with it, what's referred to as sub-account fees. And so some of those, that are kind of buried in that 700-page prospectus, they get difficult and can ultimately be kind of expensive. Number three is sales loads. Sales loads are typically a charge that's, when buying or selling an investment. So we can think about like mutual funds, certain what's called Class A, Class B, Class C mutual funds, have upfront sales loads, or they could have back-end sales loads that come off your investment based upon your time frame and how long you have them. Some of the annuities work like that too. So, some annuities have upfront charges, but most annuities have some type of time frame commitment that if you get out before that, you would pay a sales load or a sales charge called a surrender charge on an annuity if you didn't hold it for whatever the defined time frame was that you had set it up. And then there's also what's called no-load investments that are out there. Those have also become very popular. No-load investments, they don't charge sales loads. So there's no upfront sales charge. There's no back-end sales charge. And I would say, generally speaking, our firm, we tend to like things that are more no-load investments, although, again, dependent upon everybody's situation. Sometimes some of these other products can add value depending upon what you're looking at. Transaction costs. So the transaction costs, you're thinking about what is the cost of buying and selling. It could be like the bid-ask spread difference on investments. So sometimes investments that have higher turnover, meaning that they change out their portfolio a lot, can have higher transaction costs. Sometimes you have transaction costs when you're dealing with like brokerage commissions to buy and sell. To me, again, another area that I think, my 30 years of experience has gotten a lot better. I know some of the companies nowadays don't even charge commissions to buy and sell stock because they have other ways they can make their money. You could have account management fees. You could have advisor fees. Those advisor fees could be typically something that they quote out as a flat fee for service. For example, they might charge $750 a year or a one-time fee to build out a financial plan. That could be a consulting type fee that you pay. So when you look at this, although these fees kind of add up, this is an area where a lot of times consumers or investors may not always feel comfortable asking the financial firm, what am I paying today? And what is the cost if I go with your firm? But I would say this is your money. You shouldn't feel uncomfortable asking these questions. Mm-hmm. And, if you don't know what you're paying today, or maybe you feel like they're not telling you the whole story, you're the type of person that would really benefit, from that second opinion. And that second opinion is what we give in that retirement team action plan. So in that, we're going to go through 4 areas of your finances. And one of the areas that we're going to look at is how to help save costs. Look at your expenses. We'll dive deeper into that, and we'll get you the accurate information on what your expense ratios are, talking about which ones that add value and which ones maybe you could be expenses that you could eliminate, because I love helping people eliminate wasted expenses. And if you have $250,000 or more of investable assets, the way you get that is to give our office a call and ask for the Retirement Team Action Plan. And in that report, we'll get you the detailed information on what that looks like.
Because it's all about value, and if you don't know what you're actually paying, it's really difficult to assess that value. The phone number to get that Retirement Team Action Plan, which includes that second opinion and fee analysis, 419-794-3030. The website, arhq.com. Personal finance guru Susie Orman, she likes annuities that produce guaranteed income. Having that income come in, there's something to be said about it, but she's not a fan of one particular type of annuity.
The annuities that I do not like are variable annuities. A variable annuity is like a mutual fund owned by an insurance company. Within the contract, because it's a contract, it's an annuity. Oh, it gets so complicated there. However, this is what you need to know. Just stay away from variable annuities and you'll be just fine.
We kind of touched on this in a previous segment. Nolan, do you agree? What is the issue with variable annuities, and is there actually a better option?
Well, I think for the most part, Susie Orman is spot on. I generally don't give advice that say all investors should do this. So there are scenarios where a variable annuity can make sense in somebody's situation. But, I think for the overwhelming majority of investors, they don't make a lot of sense. And the reason being is when you add up the fees and expenses, that's really what is wrong with a variable annuity, number one. So when you look at a variable annuity and you slice and dice the different expense ratios, what you have is you have typically a mortality expense ratio that could range 1.25%. Then you could have, and the investment is in a sub-account. So sub-accounts are, managed by investment management teams, and you could have another, say, 1% expense ratios. Generally, people buy variable annuities because they have some type of protection or guarantee. Oftentimes in a variable annuity, it's like an income guarantee. So with an income guarantee, there's a rider expense usually associated with it. That could be another 1%. And then you can have some of these other, administrative fees. And it's not uncommon that we do an analysis and find that the average cost of a variable annuity can range between 3 and 4% a year. So if a retiree is trying to target a 6% rate of return, and they're paying 3% in fees, every year half of the money is going out just in fees and expenses. That's one of the reasons it gets a bad rap. The second reason that it gets a bad rap is variable annuities traditionally have risk associated with them. Now, there's newer products that are out there today, some of these buffered variable annuities that provide some downside risk management. You could argue that maybe you could put it in the fixed or money market account and not have risk associated with it. But the word variable indicates risk. Variable means that the investments will typically go up and down based upon what the stock market does. So, if the markets are doing well, the variable annuity goes up. If the markets go down, the annuity typically goes down in value. So the investor is assuming, and they're at the end of the day, the one that are bearing the risk associated with this contract. Worst case scenario, you put your money in like an environment that we're in right now with the market at an all-time record high, and you have an income guarantee for the rest of your lifetime because that's what you wanted. And then now all of a sudden in the first year of buying that contract, the market has a terrible downturn. And by having the terrible downturn, what that means is that you're really kind of locked into that contract. Because if you go shop at another company and you go try to figure out what it would be worth at another company, they're going to base it on the current cash surrender value. So if your annuity went down in value and you have to pay a penalty if you're going to get out of it early, your offers at the other company are traditionally going to be less, and you could be stuck and locked into that variable annuity, which may not be the best one for you as well. So, at the end of the day, when you look at this, there are some things, and you do want to understand like the fees and expenses. You do want to understand like the complexity of how they work. You do want to understand the risk that's associated with them. And sometimes even for non-qualified accounts, what you're doing is you're creating tax-deferred growth. Society has oftentimes taught us that tax-deferred growth is a great thing. And keeping the government away from your money in general, I think, is a good idea. But deferring taxes when we have a government that has no control on spending and saving money with what could be worth more in the future than what it's worth today in a tax-deferred vehicle like a variable annuity may not work out tax-wise for a lot of people, especially when you're looking to transfer that wealth to the next generation. Annuities cannot be always the best choice when it comes to passing wealth on. Sometimes there's other investment vehicles that are better choices as well. Now, we've got this topic and a whole lot more that's coming up. Again, it's in that event that we have over at Mancy's Italian on May 14th at 6 p.m., where you can come out to the event on Tuesday, May 21st at 6 p.m. We're going to be talking about the truth about retirement income annuities, the good, the bad, and the fine print. I did this interview with Susie Orman a couple of years ago. For most of you who followed us when we were the writers in the Toledo Free Press, we can have a copy of Susie's article for you there on the Money Talks. But we'd be happy to share more information about this. Again, all you have to do is go to arhq.com, hit the events tab, and register for coming out to learn more about what Susie Orman and, more importantly, what I and the team here at America's Retirement Headquarters have to say about the good, bad, and the truth about annuities.
And if for some reason you can't make it out to either of those two events, May 14th or May 21st, or you just want to jump the line and sit down with the team and let them use their 75 plus years of experience, put it to work for you and let you know the ins and outs when it comes to annuities. Again, as fiduciaries, acting in the client's best interest, they're not going to recommend anything to you that they, genuinely, truly don't believe is going to work in your best interest. So get that education, whether it is at Mancy's coming up in May or in their offices, by reaching out 419-794-3030, or you can always find out more information on the website as well, and that is arhq.com. Want to thank you, as we always do, for joining us here on America's Retirement Headquarters, home of the Retirement Guys Formula and America's Medcare Associates. Hope you have a great day ahead of you. Stay safe out there. Nolan, always appreciate the time. And as we wrap up here, I want to leave you with the final word.
Well, spring is here. I would say if you haven't taken the time to spring clean your finances, there's one thing that you should do to make your week a great week, in my opinion. That's give our office a call and get that retirement team action plan. So let us, map out a plan for you on how to help try to reduce the amount of money that you can pay in taxes in 2024 through the tax savers checklist and the tax roadmap. Let us look at your estate planning blueprint. You only get one shot at this. Make sure that you've crossed the T's and dotted the I's. Let us look at your asset protection game plan, making sure that we work towards minimizing your healthcare costs for 2024 and developed a way to put a shield around your personal assets if you or a loved one need long-term care in the long run. And last, money management. Let's optimize your investments. Let's make sure that you understand and we stress test your plan. And it's as simple as giving us a call, 419-794-3030. Just tell us, Nolan, we have and want that retirement team action plan, and we'll make that available for you. Or learn more at arhq.com. We'll see you back here, same time, same channel, right here on Toledo's largest talk station, 1370 WSPD. Thanks for tuning in. Just remember, when you think retirement, think America's Retirement Headquarters. It's home of the Retirement Guys Formula and America's Medicare Associates.
America's Retirement Headquarters is located at 1700 Woodlands Drive in Maumee, Ohio. You can reach them by calling 419-794-3030 or online at americasretirementheadquarters.com. Exposure to ideas and financial vehicles discussed should not be considered investment advice or recommendation to buy or sell any financial vehicle. Investments can fluctuate and when redeemed may be worth more or less than when originally invested. Nolan Baker is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Please consult with your attorney, accountant, and or tax advisor for advice concerning your particular circumstance. Annuity guarantees rely solely on the financial strength and claims paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Nolan Baker, Ohio Insurance License Number 27787.